Stop calling AI a bubble. Seriously. If you think the AI rally is about to crash like the dot-com bubble, well, the world's largest asset manager says you are completely wrong. Here is the counterintuitive truth that Larry Fink just told the world. The problem is not too much AI investment. The problem is too little. BlackRock's CEO says, दुनिया AI infrastructure में उतनी तेजी नहीं move कर रही जितनी चाहिए. Translation: the world is not moving fast enough on AI infrastructure. Not a bubble. The opposite of a bubble. But here's where it gets complicated. 4 hyperscalers, Alphabet, Amazon, Meta, Microsoft, are spending $650 billion on AI in 2026. Yet OpenAI's annualized revenue is just $25 billion. Anthropic, $30 billion. That's a $595 billion gap between spending and current revenue. And if the bubble bursts, your 401k, your pension, your life insurance, your bank savings, all of them have AI risk embedded. Let me break down both sides of the argument and stay until the end for the 3 secrets that will change how you think about AI and your money. I'll admit something. When I see headlines about AI bubble, I get nervous. I remember the dot-com crash, pets.com, Webvan, millions in retirement savings wiped out. But Larry Fink has a point. Today, I'm going to show you both sides of the AI bubble debate. We're going to look at Fink's argument that the world isn't investing enough, and the bear's argument that spending and revenue are completely disconnected. Most importantly, we're going to talk about what this means for your money. Because experts say if you use banks or have a retirement account, you are bearing the risk. Stay with me. Let's start with Larry Fink's actual words. Who is Larry Fink? He runs BlackRock, the world's largest asset manager with over $11.5 trillion in assets under management. When he speaks, markets listen. What he said about AI. दुनिया AI infrastructure में उतनी तेजी नहीं move कर रही जितनी चाहिए. Translation: the world is not moving fast enough. His conclusion: AI is not a bubble. The opposite is true. Meaning, we need more investment, not less. What is BlackRock doing about it? Going all in on AI. They recently announced a partnership with a hyperscaler, name not yet disclosed, to invest in data centers and energy infrastructure. The history. In 2024, BlackRock bought Global Infrastructure Partners for $12.5 billion. March 2025, partnered with Microsoft, NVIDIA, XAI, and MGX on data center investments. The counterintuitive truth? The world's largest asset manager is doubling down on AI. Billionaires are not selling, they're buying. Now let me show you the bear's argument, because it's compelling. The spending for hyperscalers, Alphabet, Amazon, Meta, and Microsoft, are expected to spend $650 billion on AI infrastructure in 2026. That's capital expenditures. Data centers, GPUs, networking, power. The revenue. OpenAI's annualized revenue is approximately $25 billion. Anthropic's annualized revenue is approximately $30 billion. Combined $55 billion. The gap $650 billion spent. $55 billion earned. That's a $595 billion difference. The dot-com comparison. In 1999, companies spent billions building fiber optic networks. Demand didn't materialize fast enough. The bubble burst. The counterintuitive truth? Bears say, the same pattern is happening with AI. Hyperscalers are spending like demand is guaranteed. But what if it's not? Now let me compare the AI boom to the dot-com bubble. There are some similarities here, like massive infrastructure spending, excitement about a transformative technology, and honestly, valuations that are kind of detached from current earnings. You also hear a lot of those, this time is different narratives. But there are some key differences too. During the dot-com era, consumer internet adoption was actually pretty slow. Think dial-up and really low bandwidth. With AI, though, actual products exist today. ChatGPT, Claude, and Gemini all have hundreds of millions of users already. Back in the dot-com days, many companies had zero revenue. With AI, OpenAI and Anthropic have billions in revenue. It's not enough to justify all the spending, but it's real revenue. Dot-com infrastructure was pretty speculative, whereas now, every hyperscaler is using AI internally to improve efficiency. So, here's the counterintuitive truth. The dot-com bubble burst because adoption was slower than expected. With AI, adoption has been faster than almost anyone predicted, but the spending has been even faster than adoption. Now let me tell you what experts are saying about your money. The quote that matters is, if you use banks or have a retirement account, you are bearing the risk. So what does that mean? Well, your 401k likely owns AI stocks through index funds. Your pension fund invests in private markets, including AI startups. Your life insurance company holds tech stocks in their general account. Your bank has invested depositor money in AI-related loans and equity. The counterintuitive truth? You cannot avoid AI risk by avoiding AI stocks. Because honestly, AI investment has infiltrated every part of the financial system. What happens if the bubble bursts? It's not just tech stocks that crash. Your retirement account, your pension, your insurance policies, even your bank savings could be affected if banks hold bad AI investments. There's the diversification illusion. You think you're diversified because you own an S&P 500 index fund, but the S&P 500 is heavily concentrated in tech, and AI is a huge part of that concentration. There is no safe harbor. Your money is at risk. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1, the bubble or not false dichotomy. Most investors think either it's a bubble or it's not. The reality is more nuanced. AI could be a bubble for some companies while being revolutionary for others. The dot-com bubble wiped out Pets.com, but Amazon survived and thrived. The same will happen with AI. The question is, which companies are Amazon and which are Pets.com? Secret number 2, the spending gap reality. $650 billion spent, $55 billion earned. That gap is real. It must close eventually. Either revenue grows massively or spending slows down. The market is betting on revenue growth. If that bet is wrong, the correction will be severe. Secret number 3, the retirement risk blind spot. Most investors don't realize that their retirement accounts are heavily exposed to AI. Even so-called safe index funds, even pension funds, even bank savings. There is no escape. The only question is how you position within the AI theme. Diversify. But understand, diversification does not mean avoiding AI. AI is everywhere. So what should you actually do with this information? For your retirement accounts, like your 401k or IRA, review your allocation. Are you overweight tech or AI? If you're decades from retirement, you can tolerate volatility. If you're near retirement, consider rebalancing. Do not sell everything. But do not assume the AI rally will continue forever. For taxable accounts, consider taking some profits if you have large gains. Not all profits, just enough to feel comfortable. No one ever went broke taking profits. For everyone, talk to a financial advisor. Not me, a real advisor who knows your specific situation. AI risk is real, but so is AI opportunity. The worst thing you can do is react emotionally to headlines. Larry Fink's final word, he's putting BlackRock's money where his mouth is, investing in AI infrastructure. He believes the world needs more AI investment, not less. He might be right, or he might be wrong, but he's the one managing $11.5 trillion. The counterintuitive truth: the biggest risk might not be that AI is a bubble. The biggest risk might be that AI is not a bubble. and you missed it because you were too scared. Here is my question for you. Do you think AI is a bubble? Or do you agree with Larry Fink that the world needs more AI investment? And does your retirement account reflect your honest answer? Drop your answer in the comments. I read every single one. Like and subscribe if you want more myth-busting analysis on the biggest market debates. I'll see you in the next video.